Okay.
Okay.
I did it again.
Hi guys, my name is Darina. I'm your New Jersey real estate bestie, and with me today we have Jonathan Nelson, who is a lender with Crown Mortgage. Hi, John.
Hey, what's going on? How you doing?
Not much. You know, the rates are rising right now, so let's talk a little bit about that. Where do we stand today?
Today we stand at around 6.875 to maybe 7%, and that's on a national average, but there is also going to be ways to get around that as well.
Oh, what are the ways to get around those 7 dreadful percent?
One of the main ways that we get around it is going to be through using a seller's concession, which is going to be called a 2-1 buy down. That 2, of course, stands for the first year where your interest rate is lowered by 2%, and then the second year is going to be lowered by 1%. Then the third year, it turns to the fully amortized rate that you first qualified for.
But you are doing that in hopes that in the period of those 2 years, the rates are going to drop and you will be able to refinance, right?
Correct. That is exactly what we plan. What the plan is when you're using a 2-1 buy down. The main thing that you have to consider is that your main objective is really getting the house at this point. And as I like to say, you're basically married to the house, and the mortgage is your mistress.
Don't start that.
So that's it. That's the best way to put it. You always can refinance.
Listen, are you among those who are like marry the house, date the rate?
Well, dude, I mean, it's a brilliant concept. That like if you live your life like that, you could marry. Dude, if you live your life like that, you're gonna be like that right there.
You are financially comfortable and ready to buy. Don't look at the rate, that is true, but buy when you're ready to buy. So, what are the chances of the rates going down? Where do you see them going?
So overall, I see them going down. I can't actually speculate on how much they will go down just because, of course, there's a lot of in play right now. We're in a kind of crazy space in our economy right now with the Fed rate rising, right? And the Fed is also looking for particular things so that they can lower the interest rate, of course. But we want to make sure that we're geared up for at least a little drop. And the reason why we say that is because if you look at a 10 to 2-year yield curve, you'll see that we're in the midst of coming up on a recession. And normally to follow with a recession is going to be the decrease in interest rates.
So that's what the history showed us throughout the years. Whenever there was a recession, the rates dropped. And the last recession, actually, like a short period, was when COVID hit. Mm-hmm. And the rates dropped first 1%, and then they stopped dropping too. But what I see now is a little of a crazy situation.
Yeah.
Because the rates are rising, the prices are going down, not at the same speed that the rates are rising.
Correct.
And also we don't have inventory at all.
Mm-hmm.
So the buyers who are still looking to buy are facing difficulties,
Correct.
And I wouldn't be so sure that the rate will drop in the next year or two.
Well, what makes you kind of unsure about that?
Because of what we see in the situation, because the people who got the mortgage at 3 and 4%, mm-hmm. they will not be willing to sell. I think there is more than 70% of mortgages right now mm-hmm. with the rate under 5%.
Yeah.
So they will not be looking to sell.
Correct.
What will be good for them if they do need to sell, it will be good for them to put out assumption mortgage.
Okay.
Right?
All right.
Is there a fee to assume somebody's mortgage?
Whenever you're assuming a mortgage, right, and it's most prominent with FHA loan products, but whenever you're assuming the fee of the mortgage, you're basically buying out the mortgage. So your closing costs are going to stay the same, right? But of course your interest rate doesn't change, which is going to be an advantageous advantage.
But when people are assuming somebody's mortgage, there is
transfer fee, basically.
Transfer fee,
yeah.
yes.
Transfer fee can vary on the rate and also the loan amount.
So if you decide to sell your house and your interest rate is better than today's, ask your mortgage provider mm-hmm. whether your loan is assumable. Yeah. All right, let's go to the next question.
Next question.
Yes,
gotcha.
We have a list of questions here actually.
Oh, that's a long list.
So the next program is USDA loan. What do you know about USDA loan? Because I just helped people buy the house with $4,000. That's all they had to put in.
Oh, wow. That's hell of a closing cost.
Yes, and well, closing costs were higher, but they had seller's concession.
Ah,
And they only had to put $4,000 out of their pocket.
correct.
And I think that included inspection too.
Hmm.
So tell us about the USDA loan, why it is so great, and who can qualify for it.
Of course, the USDA loan in of itself is going to be really geared towards home buyers that maybe not might not have a lot of money for your closing your down payment. The reason why is because this offers actually 0% financing and also has a mortgage insurance mechanism in it that actually is lower than FHA and also sometimes even conventional at that point. That's going to be the one thing that's going to save you the most money when going forward with the USDA loan. But just keep in mind that, of course, there's criteria that needs to be met with USDA loan. As I say to myself, whenever I have a client that is actually getting pre-approved and looking for a USDA loan, the home that you're buying needs to be in a rural environment. So, in other words, if you don't have a chance of seeing bears, there's probably a good chance that that home does not qualify for USDA.
So another question is, how does your credit score affect your ability to get the mortgage? And should people be concerned about their credit scores?
Absolutely. You should always be concerned about your credit score and not for nothing, just take the house out of the equation really quickly and just think about all the other things that you can do with credit overall, right? And then also estimate your liabilities that you currently have. If you know your liabilities, such as your car payment, your credit card payment, maybe even a rental bill that might be on your credit report, then you should definitely take into account what you can do to actually increase your score because the better the score, usually the better the financing opportunity.
So we are coming to applying for the loan. What documents do we have to bring with us?
Alrighty, so normally whenever you're coming to apply with me, there's four main documents that we're really looking for initially, right? That's going to be your 2 years most recent W-2s, and it's also going to be 60 days most recent bank statements, 30 days most recent pay stubs, and of course a driver's license. Some oftentimes that you will have, if you happen to own your own business, we will want to see your two most recent tax returns, right? So that we can actually estimate your income and then put it against the home that you're trying to buy.
And is it the same documents for self-employed and W-2 employees?
So that's where the overlay is actually there, right? So for of course a self-employed individual, right, most likely they will be paid in 1099s, or if they're not paid in 1099s, they most likely have an LLC that they have business tax returns for. So basically said, self-employed individual, most likely 1099, 1040s, and then you will also have sometimes your 1065s, or if you have an S corp, right, you'll have your 1120Ss that you need to provide. If you're a W-2 employee, for example, it makes it that much simpler. That's just your W-2s at that point, and of course, right, your 60 days most recent bank statements, pay stubs, and your driver's license. The last three that I just said are the most common denominators in any quantification.
Okay, John, what about the money? How much money do I need for a down payment?
All right. So talking about brass tacks, let's say you're buying a $400,000 home, you would be looking to probably need around $14,000 just for your down payment at a 3.5%, right? Then you would be looking at your closing costs. Your closing costs are normally going to range about maybe 3% of the transaction, especially if you're looking to buy, right? So you can most likely bet to add another $12,000 on top of that with a grand total of $26,000 that you will need, right? Now that is
For a
just
400,000
for
home.
for a $400,000 home. But then keep in mind, right, that you also your taxes and your other liabilities that come along with your mortgage payment will also determine the amount that you pay in closing.
So, John, how much of the closing costs is associated with getting a mortgage?
Oh, actually, I just had this question. Somebody just asked me that. That's funny.
I
So,
asked you that question.
no, 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 no. It wasn't you. It was a client. It wasn't you. No.
All right. So the application fee and all the fees of the mortgage, how much are they?
So basically the main thing that comes from the mortgage company is going to be the bank fee. But of course, right, whenever you're going through it with your mortgage lender, we're all about finance. So we want to incorporate and at least stage a couple of different types of products that you will definitely have to pay for, and then at least make sure that you have an idea of what you need to cost at the closing table. Because I'll tell you right now, our bank fees, which is our application fee and our processing fee, it comes to about $1,500, but that's not the overall cost of closing.
Okay, so be prepared with
Be
the closing costs.
prepared.
Also, don't forget that in this market, the one that we see right now, downgraded market, you can actually put your closing costs in the mortgage to get like a seller's concession, to
Correct.
ask the seller to pay for a part or fully your closing costs. John, how much of a closing costs can we put in the mortgage?
So depending on the loan amount, you're allowed to put down as far as a seller's credit, right?
Yes.
Correct. As far as a seller's credit is concerned, it depends on that loan that you're particularly taking out. So let's just say, for example, for a conventional loan, it's usually anything less than 5% or less as a down payment will be around 3% of the transaction, right? So you can put down 3% and then it can't exceed your closing. So you can't have if your closing costs are $12,000, you can't have a seller's credit that is going to be $14,000.
But you can't take cash.
You can't take cash.
So even if it's 14,000, you can only take 12.
Correct. Yes.
And one of the last questions that should have been our first. How does one qualify for the mortgage?
Alrighty. So then this is really simple. So you can qualify for a mortgage. You can qualify online, of course, by going to jnelson.crownhm.com. And then, of course, you can fill out an online app. Afterwards, we will go over our loan consultation, or you can even call me to actually get a loan consultation, and we could do everything right there and then.
And how do people find you?
People can find me. I'm basically all over the place. I mean, I'm on Facebook. Yeah, you'll see me around here somewhere.
Oh, you can find him on Tinder.
Oh shit! Oh God. Of course. All right, guys. Of course, it was a pleasure. We will see you guys later.